Imagine walking into your boss's office, losing your entire performance bonus for the rest of the year, and somehow walking out with more money in your bank account than you have ever had in your life.
I mean, it sounds like an impossible financial magic trick, right?
It really does.
Yeah.
But that exact scenario is basically what just happened in the defense and technology sector.
Yeah, it's pretty wild to watch play out in real time.
Absolutely. Welcome to a special Talk Tickers edition of our Deep Dive. Today we are taking the Q2 2026 earnings call for Leidos Holdings Inc., dash ticker symbol LDOS, and putting it under the microscope.
And we've got a lot of ground to cover with this one.
We really do. We have the raw transcript from management along with a stack of our own research notes. We're covering everything from their new autonomous naval software to their sovereign cloud infrastructure.
Because, the mission today is to cut through the heavy Wall Street jargon and all those dense government acronyms.
Right. We want to extract the actionable plain language insights you actually need to know. If you currently hold this stock in your portfolio, or if you're considering taking a position, you need to understand the mechanics here.
Because you really have to see how this company just pulled off a record quarter while actively losing a major revenue stream.
Okay, let's unpack this. The superficial narrative on the financial networks often misses those underlying mechanics, doesn't it?
Oh, completely. I mean, earnings calls are fundamentally designed for institutional analysts who spend their entire lives modeling specific sectors.
Which means the executives use a shorthand that completely bypasses the retail investor.
Exactly. But when you break down that shorthand and actually look at the physical operations of the business, like what they are actually building, shipping, and coding, a very clear picture emerges.
And the situation with Leidos right now is basically a study in how a diversified conglomerate absorbs a massive unexpected hit.
Yeah, they took a hit to one part of their business by just throttling up the engines in completely different sectors. It's really a masterclass in portfolio resilience.
Well, let's get right into the data drop, starting with the headline numbers. Because to understand that resilience, we have to look at the sheer volume of capital flowing through this enterprise.
The numbers are staggering.
They really are. For the second quarter of 2026, Leidos posted revenue of $4.56 billion. That is a Q2 record for the company.
And that represents a 7% increase year over year in total revenue.
Right, and a 4% increase when focusing specifically on organic growth. Now, I want to pause on that term, organic growth, because companies throw it around constantly in these transcripts.
And they do, all the time.
So in the context of a massive defense contractor that frequently acquires other companies, what does a 4% organic growth rate actually tell us about the health of the underlying business?
Well, it's honestly the most vital metric for assessing the core engine of the enterprise.
Why is that?
Because when a company reports total revenue growth, that number can be artificially inflated by simply buying another business.
Ah, right.
If a corporation buys a competitor that generates $1 billion a year, their total revenue immediately spikes by $1 billion.
But that doesn't mean they're necessarily better at their job, right?
Right.
Or winning more contracts.
Exactly. They just bought revenue. Organic growth strips all of that noise away. It excludes the revenue from any acquisitions made within the last year, and it adjusts for foreign currency fluctuations.
So when Leidos reports 4% organic growth, it means their existing portfolio, the contracts they already held, and the teams they already had generated 4% more revenue.
Yeah, by winning new task orders, scaling up production lines, and outcompeting rivals for incumbent work, the core machine is running faster, independent of any external purchases.
That distinction is crucial. You want the core engine running hot. And moving down the income statement, that $4.56 billion in top-line revenue translated into significant bottom-line earnings.
Right, their non-GAAP diluted earnings per share came in at $3.26.
But the profitability metric that really stands out in the transcript is their adjusted EBITDA margin, which they maintained at 13.8%.
Which equates to roughly $631 million.
Now, if you are used to looking at software as a service companies, a 13 or 14% margin might not sound very high, right?
Yeah, software companies build a piece of code once and can sell it 1 million times with almost zero marginal cost, leading to massive margins.
Right, but Leidos isn't just selling software licenses. They are integrating massive physical systems, building hardware, and deploying tens of thousands of human beings into highly secure environments.
It's a completely different beast.
Exactly. So holding a 13.8% margin in the physical world of government contracting seems like a heavy lift.
Oh, it requires an intense level of operational discipline. The government services sector is traditionally characterized by high volume and lower margins because it's incredibly labor-intensive.
Like just paying for all those security clearances alone.
Right. When you are deploying cleared personnel to manage intelligence databases or maintaining physical infrastructure on military bases, your overhead is immense. You're dealing with supply chains, hardware procurement, physical logistics.
So to push an adjusted EBITDA margin to nearly 14% in that environment means management is aggressively identifying inefficiencies, right?
Yes. Automating whatever processes they can, and most importantly, shifting their mix of business away from basic IT maintenance and toward higher value proprietary technology solutions.
That shift toward proprietary tech is something we are going to explore deeply in a moment because it really is the entire thesis behind their current valuation.
It is the main driver, for sure.
But first, we have to look at the cash generation because this is the data point that requires a second look. Operating cash flow reached a Q2 record of $793 million.
And free cash flow came in at $761 million.
Let's break down the cash conversion cycle here. We just talked about earnings per share, which is $3.26. Why do we need to look at free cash flow separately?
Because net income, which drives earnings per share, is an accounting construct. It includes a variety of non-cash expenses, the most common being depreciation and amortization.
Can you give an example of that for the retail investor?
Sure. If Leidos buys a massive piece of testing equipment for a lab, they don't expense the entire cost in one quarter. They depreciate it over several years.
Okay, so their net income might look lower on paper because of that depreciation expense, even though no actual cash left the building this quarter for that equipment.
Exactly. Free cash flow strips out the accounting fiction. It is the cold, hard cash left in the bank account after the company has paid its employees, satisfied its suppliers, and made the necessary capital investments to maintain its own infrastructure.
Wow. So when a business converts its earnings into free cash flow at this high of a rate, pulling $761 million in pure cash out of a $4.56 billion revenue stream in a single 90-day period, you are looking at a highly optimized operation.
What's fascinating here is how it's the ultimate truth teller in corporate finance. You can manipulate earnings with accounting assumptions, but you cannot fake cash in the bank.
And Leidos is hoarding a massive amount of cash right now. The balance sheet shows they ended the quarter with $748 million in cash and cash equivalents.
And they deployed their cash strategically to strengthen the balance sheet during this quarter, too.
Like paying down debt.
Exactly. A prime example is the complete payoff of their remaining $300 million in commercial paper.
Okay, commercial paper. Let's define that for a second. That's a mechanism that large corporations use to manage short-term liquidity, right?
Yes, it consists of unsecured, short-term promissory notes, usually maturing anywhere from a few days to 270 days.
Why would a company like Leidos issue that in the first place?
Companies issue commercial paper to meet immediate cash needs, like covering a massive payroll cycle before a government payment clears. Or, in the case of Leidos, helping to quickly fund a strategic acquisition, like their recent purchase of a company called SES.
So it's essentially a corporate credit card used for massive short-term expenses.
That's a perfect way to look at it.
So paying off a $300 million balance on that short-term debt is a clear signal of financial health.
Yeah.
And that payoff had a direct impact on their leverage metrics, didn't it?
It did. The transcript notes their gross leverage was driven down to 2.5 times.
Let's decode that. Gross leverage is the ratio of a company's total debt to its EBITDA earnings before interest, taxes, depreciation, and amortization.
Right. So if you generate $1 billion a year in EBITDA and you carry $2.5 billion in debt, your leverage ratio is 2.5 times.
And in the government contracting space, where revenues are generally stable and backed by the U.S. Treasury, anything under a 3.0 ratio is considered extremely healthy.
Bringing leverage down to 2.5 times provides management with immense financial optionality.
Because they aren't bogged down by interest payments.
Exactly. When your debt load is light and you are generating $761 million in free cash flow a quarter, you are entirely insulated from the...
So if interest rates remain elevated, Leidos doesn't care. They don't need to borrow money to fund their operations.
They have the internal capital to self-fund research and development, pursue aggressive share repurchases, increase dividends, or act as an apex predator in the merger and acquisition market if a competitor falters.
It is a position of absolute structural strength. So record revenue, an optimized cash conversion cycle, and a balance sheet that is actively deleveraging.
But financial metrics in a vacuum only tell us what happened, not why it happened.
Right. To understand why this cash engine is running so hot, we have to look at the operational machinery. And right now, the primary driver of this entire enterprise is their defense segment.
The momentum in their defense segment is really the anchor of this earnings report. And the clearest indicator of that momentum is a metric known as the book-to-bill ratio.
I'll spend some time on the mechanics of book-to-bill because it dictates the entire future of the company.
For anyone evaluating government contractors, this is the single most important leading indicator of future revenue.
And in the second quarter, the defense segment posted a book-to-bill ratio of 2.2x.
Which is massive. If you pull back and look at the trailing 12 months, it sits at a very robust 1.9x.
Let's make sure everyone understands this. It measures the amount of new signed orders, the bookings, relative to the amount of work the company actually performed and billed to the customer in that same time frame.
Right. So if you bill the Pentagon for $100 million of work in Q2, but you only sign contracts for $90 million in new work, your ratio is 0.9.
And that is a shrinking business. You are burning through your backlog of future work faster than you can replace it. But Leidos didn't post a 0.9. They posted a 2.2.
Which means for every single dollar of work they executed and billed to the government in the second quarter, they received $2.20 in brand new, legally binding orders.
The velocity of their contract pipeline is just staggering.
CEO Tom Bell highlighted that they booked $5 billion in net awards overall, but the defense sector is where the structural growth is locked in.
When you see a segment sustain a book-to-bill ratio over 2.0, revenue growth for the next 24 to 36 months is virtually guaranteed, isn't it?
It is. The company does not have to hope the market expands. The contracts are already sitting in the filing cabinet.
But this raises a critical question about the nature of those contracts. Leidos has historically been known for IT services managing networks, doing systems integration, handling back-end logistics.
Right, the traditional IT stuff.
You don't generate a 2.2 book-to-bill ratio by just renewing standard IT maintenance contracts. You have to be selling something new, something the military desperately needs right now.
And the transcript gets into the weeds on the specific defense technology programs driving this surge. It reveals a massive pivot in their business model.
What's fascinating here is that the market is just beginning to price in this transition. Leidos is aggressively moving into hard defense technology, weapon systems, and autonomous integration.
The most prominent example in the transcript is a $1 billion framework agreement with the Department of Defense to deliver 3,000 low-cost containerized munitions, or LCCMS, by the year 2030.
Low-cost containerized munitions. We have to unpack this because it sounds like a concept from a military science fiction novel, but it represents a fundamental shift in global naval and land warfare strategy.
It really does, because for decades, the United States military projected power through massive, centralized, incredibly expensive platforms.
Think of a multi-billion-dollar aircraft carrier or an Arleigh Burke-class destroyer.
Right, and those platforms carry highly sophisticated, exquisite missiles that cost millions of dollars each.
The problem is, if an adversary manages to disable that one carrier or that one destroyer, a massive percentage of your striking power vanishes instantly.
Exactly. Which is why the new strategic doctrine is called distributed lethality. And containerized munitions are the physical embodiment of distributed lethality.
So the concept is to move away from relying solely on specialized warships.
Right. Instead, you design highly capable, relatively inexpensive cruise missiles or loitering munitions that can be fired directly from a standard 20-foot equivalent unit, a TEU shipping container.
Wait, like the exact same corrugated steel containers you see stacked by the thousands on commercial cargo ships or rolling down the highway on the back of semi-trucks?
The exact same ones.
The strategic implications of this are wild. If you can launch a swarm of precision munitions from a standard shipping container, suddenly every single commercial flatbed truck, every rail car, and every generic cargo vessel becomes a potential missile battery.
It creates an absolute nightmare for an adversary's targeting and intelligence apparatus. I mean, they can track an aircraft carrier via satellite with relative ease. They cannot track every shipping container in the Pacific theater.
That makes total sense. And the economics of warfare are driving this shift too, right?
Yeah, absolutely. The military recognizes that in a peer-level conflict, they will exhaust their stockpiles of million-dollar interceptors and strike missiles in a matter of weeks.
They need volume. They need thousands of munitions that are good enough rather than hundreds that are perfect.
And Leidos stepping in to deliver 3,000 of these low-cost systems by 2030 is a clear signal that they have developed the manufacturing and engineering capability to produce hardware at scale.
And they estimate the total addressable market for these types of decentralized munitions over the next decade exceeds $44 billion.
The initial $1 billion framework is merely the vanguard of a massive procurement wave.
And their pivot into hardware doesn't stop with offensive munitions. They are also heavily involved in base defense. The management team highlighted their success in scaling production on a program called IFPIC, which stands for Indirect Fire Protection Capability.
Right. IFPIC is a mobile, ground-based weapon system designed to defeat a very specific set of threats: cruise missiles, large unmanned aerial systems, and artillery rockets.
It's essentially a layered air defense system that protects fixed or semi-fixed assets.
We see the urgency of this technology playing out every single day in current global conflicts.
Yeah, the proliferation of cheap, mass-produced attack drones has fundamentally altered the battlefield. We are seeing state and non-state actors using drones that cost maybe $20,000 or $30,000 to manufacture.
And they are launching them in swarms to overwhelm traditional air defenses. This is the asymmetric cost curve problem.
Explain that asymmetric cost curve a bit more.
Sure. If an adversary launches a $20,000 drone and you shoot it down with a Patriot missile that costs $4 million, you have successfully defended your base, but you are losing the economic war.
Because you will go bankrupt before they run out of drones.
Precisely. The IFPIC system is designed to provide a more economically sustainable layer of defense, utilizing interceptors like the AM-9X Sidewinder, integrated with advanced radar and command and control software.
And Leidos is acting as a primary integrator here, managing the complex software architecture that allows the radar to talk to the launcher and fire the interceptor in fractions of a second.
And the transcript notes they are hitting their full stride in production, delivering an increasing number of these units every month.
So they have containerized strike missiles and advanced base defense systems. They also highlighted a proprietary program, the AGM-190A, which the Air Force has recently designated as the Havoc Spear.
Havoc Spear. Yeah, this is a small air-to-ground cruise missile developed internally by Leidos.
It is currently undergoing active flight tests and being deployed in military exercises. Management noted they are in deep conversations with both the U.S. Air Force and Special Operations Command to scale Havoc Spear into an entire family of smart weapon systems.
And their reach extends into the maritime and space domains as well.
Right, through their naval architecture subsidiary, Gibbs & Cox.
Leidos is deeply involved in the design and testing phases of the Navy's next-generation medium unmanned surface vessels. These are drone ships capable of operating autonomously for thousands of miles.
And they are powering these vessels with proprietary autonomous software called LAA. They are even engaged in the preliminary design work for the DDGX, which is the Navy's concept for its next-generation guided missile destroyer.
And in space. They are manufacturing specialized sensing payloads for low Earth orbit satellites. The critical detail management shared regarding the space segment is that with every new production tranche they deliver to the government, their profitability margin increases.
Because they are mastering the manufacturing curve.
Exactly. When you aggregate all of this autonomous naval software, space payloads, cruise missiles, base defense, you realize the defense segment is no longer an IT services business.
No, it is a high-margin, specialized hardware and software engineering firm. That structural evolution explains the 2.2x book-to-bill ratio. The defense engine is firing on all cylinders.
But, earlier we framed this entire deep dive around a paradox.
Yes, we talked about a financial magic trick where a company loses a major revenue stream and still posts record profits. Because while the defense sector is surging, Leidos is currently navigating a brutal headwind in their health segment.
This brings us to the most complex issue in the earnings report, the VBA Medical Disability Exam Program.
This specific contract is the central tension of the quarter. The Veterans Benefits Administration, the VBA, is responsible for evaluating disability claims submitted by military veterans.
And to handle the massive volume of these evaluations, the government utilizes commercial vendors to conduct compensation and pension exams, known as C and P exams.
Right. And Leidos, primarily through its QTC subsidiary, is one of the largest providers of these exams in the country.
They manage a sprawling logistical network consisting of over 15,000 medical providers, 90 dedicated clinics, and they process roughly 2.8 million individual examinations every single year.
It is a massive logistical undertaking. And the financial structure of this contract is where the current problem lies.
Because historically, the VBA contract included a base rate for conducting the exams, coupled with significant financial incentives based on performance metrics.
So if Leidos completed the exams faster than required, or if the error rate on the complex medical paperwork was exceptionally low, they earned bonus payments.
And those incentive fees are essentially pure margin.
Wait, really? Pure margin?
Pretty much. The base contract covers the overhead, the clinics, the doctors, the administrative staff. The incentive payments flow almost entirely to the bottom line as profit.
But the VA recently initiated an administrative review regarding the auditability and distribution of these specific incentive payments.
Yeah, and as a direct result of that ongoing review, the VA notified all commercial vendors, not just Leidos, but the entire industry, that they are completely suspending all incentive payments for the remainder of 2026.
Wow. To lose the highest margin portion of a major contract for the back half of the fiscal year is a material, unexpected blow to the profitability of the health segment.
And management was transparent about this, acknowledging that revenues in the health division actually contracted during the quarter as they absorbed this loss.
Compound that with the planned onboarding of a force vendor into the regional exam network, which diluted their total volume.
Yeah.
I have to challenge the market's reaction to this, though, because the mechanics don't seem to add up at first glance. Well, if you run a business and your highest margin product line is suddenly crippled by regulatory suspension for 6 months, your overall profitability should tank. The stop should take a massive hit.
That's the logical assumption, yes.
How does a company absorb the total loss of incentive payments on a volume of 2.8 million medical exams and not only survive, but post a record $793 million in operating cash flow and actually raise their future financial guidance? It defies basic corporate gravity.
It demonstrates the power of portfolio offset. This is the exact reason institutional investors place a premium on well-managed, diversified conglomerates.
So if Leidos were solely a healthcare logistics company, the VA suspension would be devastating.
It would be game over for the quarter. But Leidos operates 4 distinct engines. The health engine undeniably sputtered this quarter. But the other 3 engines accelerated so dramatically that they completely overwhelmed the shortfall.
We already explored how the defense engine went into overdrive with the munitions and the autonomous tech. What were the remaining 2 segments doing to cover the gap?
The most surprising outperformance came from the Homeland segment, which exploded with 32% total revenue growth and 15% organic growth year over year.
Wait, 32% growth in a single quarter for a segment focused on domestic infrastructure? The Federal Aviation Administration and the Department of Energy don't exactly move at light speed. What is driving a 32% spike?
It's a combination of...
And the final segment, intelligence and digital, also maintained a very strong growth trajectory.
Yes, driven predominantly by their deep integration with the intelligence community. They are expanding beyond traditional cybersecurity and leaning aggressively into sovereign cloud architecture and artificial intelligence.
Sovereign cloud. Now, that is a term we are hearing more frequently. What does that actually mean in the context of the intelligence community?
Well, commercial cloud providers like Amazon Web Services or Microsoft Azure are phenomenal for enterprise businesses. But agencies like the CIA or the NSA cannot risk having highly classified intelligence data processed on multi-tenant commercial servers.
Because the underlying hardware might be shared or the physical supply chain of the servers isn't completely controlled.
Right. Sovereign cloud is a dedicated, physically isolated, highly secure computing environment built specifically for classified workloads. It guarantees that the data remains under strict national control.
And Leidos just announced a massive strategic partnership with a company called CoreWeave to build this out.
CoreWeave is one of the premier specialized cloud providers for GPU-accelerated computing.
Which is the exact type of raw processing power required to run advanced artificial intelligence and machine learning models.
Exactly. The intelligence community desperately wants to deploy generative AI to analyze satellite imagery, intercept communications, and predict threat patterns. But they cannot do it on public AI models.
They need a secure sandbox.
Precisely. And building that sandbox is incredibly difficult. You have to construct facilities known as SCI sensitive compartmented information facilities.
And SCIF isn't just a locked room, it's an engineering marvel.
Oh, the walls must be lined with copper shielding to prevent electromagnetic emanations from leaking out. The acoustic dampening must be absolute.
And I imagine the power and cooling infrastructure required to run clusters of massive AI GPUs inside a sealed, shielded room is immense.
It's a massive technical hurdle. But Leidos has decades of experience building SCIFs and managing classified networks. By partnering with CoreWeave, they are positioning themselves as the primary toll road for bringing high-performance AI capabilities securely into the intelligence community.
So the offset mechanism is incredibly clear. Homeland infrastructure revenue spikes by 32%. The intelligence segment locks in sovereign AI partnerships.
And the defense segment books $2.20 for every dollar billed by selling containerized cruise missiles.
That is how the portfolio absorbs the loss of the VA health incentives without missing a beat. And it's crucial to note that management isn't just ignoring the health segment.
No, the transcript indicates they are aggressively deploying automation and technology insertions into their other health contracts.
Like pre-discharge exams for active duty personnel and international medical exams. They're doing this to protect the margins in that division as much as possible while the VA conducts its audit.
And this immediate operational pivot to protect margins while leveraging growth in other sectors leads us directly into our next area of focus: management guidance.
Because interpreting a company's past performance is helpful, but their forward-looking guidance dictates how the market will value the stock tomorrow.
And the forward outlook they provided is arguably the strongest signal in the entire earnings call.
Let's look at the context. Management is fully aware that they will not receive a single dollar of VA incentive payments in the third or fourth quarters.
That negative financial impact is known, quantified, and already baked into their projections.
Despite carrying that dead weight, they came out and raised the midpoint of their total revenue guidance for 2026 by $100 million, specifically bumping up the lower end of their expected revenue range by a full $200 million.
They also raised the lower end of their earnings per share guidance by 10 cents.
But as we discussed earlier, earnings can be an accounting metric. The cash flow guidance is where the true strength of the business is revealed.
Right. They officially increased their operating cash flow guidance for the year by $50 million.
And simultaneously, CFO Chris stated that they are adjusting their capital expenditure projections downward. They are lowering CapEx to roughly $250 million for the year.
Let's do the math on the implied cash flow, because this is the critical data point for the retail investor.
Right. Free cash flow is calculated by taking operating cash flow and subtracting capital expenditures.
So management is telling the market that their operating cash flow is going up by $50 million, while their required spending on infrastructure and equipment CapEx is going down by roughly $100 million compared to prior estimates.
Therefore, their implied free cash flow guidance actually jumped by $150 million.
They expect to generate $150 million more in pure, unencumbered cash this year than Wall Street analysts had modeled just 3 months ago.
And they're doing it with a broken health contract.
It sends a profound psychological signal to the institutional market. It demonstrates supreme confidence in the $12 billion pipeline of defense technology options they are currently pursuing.
In fact, the CFO explicitly stated that if you remove the transitional airborne intelligence, surveillance, and reconnaissance business, which they are intentionally reshaping, the core defense segment is projected to grow at double-digit rates through the end of 2026.
They are essentially broadcasting, our cash conversion cycle is so efficient and our defense tech backlog is so massive that we don't need the VA incentives to break cash flow records.
It really highlights their commitment to a low capital intensity business model. CEO Tom Bell stressed this point.
Yeah, unlike a commercial aerospace company that has to spend billions of dollars building massive physical factories to assemble airplanes, Leidos' capital expenditures hover around 1 to 1.5% of their total revenue.
Because they are primarily writing software, integrating systems, and managing data.
Yeah.
The physical hardware they do build, like the containerized munitions, utilizes standardized components and scalable manufacturing that doesn't require massive upfront infrastructure costs.
A low capital intensity model generating nearly $800 million a quarter forces the board of directors to make a critical decision regarding capital allocation.
What does a company do with all this excess cash when they don't need to build new factories?
They return it to the shareholders.
Right. During the second quarter, management completed their previous 2022 share repurchase program, buying back $66 million worth of stock on the open market.
And more significantly, the board has just authorized a brand new, massive share repurchase program.
For the retail investor, a share repurchase program, executed effectively, is one of the most powerful mechanisms for wealth creation.
Let's explain the underlying math of a share buyback. When a company utilizes its free cash flow to purchase its own shares on the open market and subsequently retires them, it permanently reduces the total number of outstanding shares.
Imagine the company's total profit is a pie, and every share of stock is a slice. If the size of the pie remains exactly the same, but the company buys back and destroys 10% of the slices, every remaining slice suddenly becomes 10% larger.
The earnings per share, the EPS, increases mechanically, even if the actual net income of the business hasn't grown by a single dollar.
When the EPS goes up, the stock appears cheaper on a price-to-earnings valuation basis, which inevitably attracts new institutional buyers and drives the stock price higher.
But buybacks are only effective if management buys the stock when it is undervalued. If they buy at the top of a bubble, they are destroying shareholder value.
Which is why a specific comment from the CEO during the Q&A session was so telling.
Yes, an analyst specifically asked management how they plan to balance internal growth investments, potential mergers and acquisitions, and this new share repurchase authorization.
And the CEO was unusually candid. He stated that right now the valuations of potential M&A targets in the defense sector are prohibitively expensive.
However, he noted that Leidos' own valuation, the multiple the market is assigning to their earnings, is highly attractive.
He effectively went on record and told Wall Street, "We think our stock is cheap."
When the CEO signals that the company is undervalued and arms himself with a newly authorized cash-funded buyback program, it establishes a very firm mechanical and psychological floor for the start price.
If the market sells off, Leidos will simply step in and buy their own shares at a discount.
I want to pivot to another crucial dynamic discussed in the Q&A that directly impacts this cash generation, and it involves the political calendar.
And we must look at this strictly through the lens of federal contracting mechanics, entirely independent of partisan politics.
Exactly. An analyst inquired about the sudden acceleration in contract awards. The pipeline is moving faster than expected. Why is the federal government suddenly so motivated to sign these deals?
The CEO provided a macro perspective on federal spending behavior. He observed that the current administration is making a concerted effort to demonstrate tangible results to the public ahead of the November midterm elections.
He cited a specific projection from a cabinet secretary indicating that the vast majority of unobligated funds from the 2025 reconciliation budget will be officially put on contract before October 1st.
This is a textbook example of the use it or lose it phenomenon in federal budgeting, amplified by an election cycle.
The Anti-Deficiency Act strictly regulates how federal agencies spend appropriated funds. If an agency has money sitting in its accounts that has been authorized by Congress, they must obligate those funds, meaning they must sign a binding contract with a vendor before the end of the federal fiscal year on September 30th.
If they do not, those funds expire and return to the Treasury. And the agency risks having its budget slashed the following year because they couldn't demonstrate a need for the money.
Combine that structural September 30th deadline with the political pressure to announce new infrastructure and defense projects before voters go to the polls in November, and the administrative red tape vanishes.
Agencies are highly incentivized to clear their desks and sign contracts. For a company like Leidos, which is currently sitting on a massive pipeline of $23 billion in submitted proposals, awaiting adjudication, this creates a massive tailwind.
The federal calendar is actively forcing their customers to make purchasing decisions faster.
It is a critical variable for investors to monitor. Federal spending is rarely linear. It is highly seasonal, with massive spikes in the third calendar quarter.
And Leidos is structurally positioned to capture a significant portion of this late-year spending surge. Furthermore, management was asked about the perennial risk of a continuing resolution, a CR.
Right. A CR occurs when Congress fails to pass a formal budget and instead passes a stopgap measure funding the government at the previous year's levels. Under a CR, new program starts are generally prohibited.
A CR usually terrifies defense investors because it freezes new revenue.
Yet the CFO was entirely unfazed by the prospect. He pointed out that the Homeland segment is driven largely by commercial energy and international air traffic dynamics, completely insulating it from a U.S. government shutdown.
And the defense segment is already operating on signed long-term contracts. The book-to-bill ratio of 2.2x means the revenue is already locked in. They don't need Congress to pass a new budget to keep building IFPIC systems or containerized munitions.
The backlog protects them from legislative gridlock. So, we have analyzed the headline financials, we have broken down the operational story of the defense surge offsetting the health headwinds, and we have examined the mechanics of their forward guidance and share repurchases.
Which brings us to the final phase of our deep dive, the bottom line.
This is where we synthesize all this complex data into a clear, actionable verdict for the retail investor. So what does this all mean?
Based on a comprehensive reading of this transcript and the underlying mechanics of their portfolio, the verdict is definitively bullish.
Okay. Bullish, even with the VA issue.
Yes. The market will always find a reason to fret over near-term noise. You will hear chatter about the VA health contract suspension or reports that the Defense Health Agency wants to insource some of the integration work for the MHS Genesis system.
Let's quickly clarify MHS Genesis for the listener. This was a colossal contract Leidos won years ago to completely overhaul and modernize the electronic health records for the entire military health system, replacing dozens of legacy systems with a single integrated platform.
It was a massive revenue generator for years. The DHA wanting to bring some of that ongoing maintenance work in-house sounds like a negative.
It is a transition, but it is a natural one. When you build a massive enterprise-wide software architecture for the government, eventually the build phase ends and it transitions into a lower margin sustainment phase.
Exactly. The government taking over some of that routine maintenance is a known quantity. These are transitionary speed bumps. They are administrative pauses or anticipated shifts in the life cycle of a contract.
They do not alter the fundamental trajectory of the enterprise. If you look past the noise of the VA audit and the Genesis transition, you are looking at an enterprise whose primary growth engine, the defense segment, is projected to grow by double digits.
Fueled by a $12 billion pipeline of near-term opportunities and an aggressive shift toward hardware manufacturing and proprietary software.
For the retail investor, the actionable takeaway is that you must fundamentally reevaluate how you classify Leidos in your portfolio. For a decade, the market has treated them as a traditional, slow-moving IT services company.
The perception was that they fix government computers, manage server farms, and process administrative paperwork.
That outdated perception is precisely where the investment opportunity lies. Leidos is actively shedding that legacy identity and transitioning into a high-margin defense technology powerhouse.
We have detailed the evidence. They are designing autonomous unmanned surface vessels, manufacturing space-sensing payloads, engineering small air-launched cruise missiles, and building software-defined base defense systems.
They are partnering with hyperscale providers like CoreWeave to deliver sovereign artificial intelligence to the intelligence community. They're deploying proprietary data analytics platforms on fixed-price, outcome-based contracts where they capture massive margins if they deliver efficiently.
This is the operational profile of an agile technology company, not a legacy federal services firm.
You are holding a highly efficient, cash-generating technology company that is learning to operate at the speed of software. To drive this point home, I want to highlight an anecdote from the CEO's opening remarks that encapsulates this entire transition.
The Operation Jailbreak Hackathon.
Yes, the Army's Operation Jailbreak.
It is a highly illustrative case study. In the military context, a hackathon or a rapid prototyping sprint is an intense competitive environment where engineering teams from various defense contractors are brought together to solve complex, real-world technical problems in real time.
Often over just a few days. During Operation Jailbreak, Leidos deployed a joint team of engineers drawn from both their defense hardware division and their digital software business.
And their objective was to rapidly develop and deploy secure, open application programming interfaces, the API, is to integrate disparate battlefield systems.
The result of this sprint was staggering, and it requires us to understand the history of defense procurement.
Because for decades, the Pentagon has been trapped in a cycle of vendor lock-in. A massive defense prime contractor will build an incredible radar system, but they write the software using proprietary closed code.
Then another company builds a missile system, also using proprietary code. When the military tries to connect the radar to the missile, they can't. The systems refuse to talk to each other.
And the Pentagon is forced to pay the original contractors billions of dollars to build custom, clunky workarounds. This lack of a seamlessly integrated, software-defined battlefield is the military's biggest vulnerability.
It is a critical failure point in modern multi-domain operations. The Department of Defense is desperately trying to mandate what they call MOSA, Modular Open Systems Approach.
They want systems to be plug and play. In Operation Jailbreak, the Leidos engineering team didn't just prove they could make their own hardware integrate seamlessly with the Army's evolving command and control architecture.
They demonstrated the ability to use open documented API is to achieve secure interoperability on non-Leidos systems.
They actually made their competitors' hardware communicate better and faster than the original manufacturers could, and they finished the sprint objectives ahead of the rest of the industry pack.
They dominate a military hackathon by writing superior code that solves the Pentagon's most expensive headache. An APIS High is simply a software bridge that allows two applications to talk to each other.
Right, so if Leidos is the company writing the open API, is that connect the entire battlefield, the radar, the drones, the artillery, the satellites? They become the indispensable central nervous system of the military.
It proves that the future of warfare is no longer about which company can bend the thickest sheet metal for a tank. It is about which company writes the best integration software.
When you combine that level of technical leadership with a management team that is actively buying back their own undervalued shares, generating nearly $800 million in quarterly operating cash flow, and raising future guidance despite taking a temporary hit to a major healthcare contract, you have an exceptionally compelling investment thesis.
The downside risk is heavily mitigated by their cash generation and the mechanical floor of the share buybacks, while their upside potential in autonomous defense tech, sovereign AI, and open architecture integration is just beginning to scale.
If we connect this to the bigger picture, it perfectly illustrates why investors must analyze the underlying mechanics of a diversified business rather than reacting to superficial headlines.
To bring all of this together, the record headline financials prove the cash engine is incredibly efficient. The operational story reveals that a massive surge in defense tech and domestic infrastructure completely offset a severe regulatory headwind in the health segment.
And management's guidance projects accelerating cash flow and aggressive share repurchases. Our verdict is highly bullish, driven by their successful transition from a legacy services provider into a pure-play defense tech integrator.
And that leads us to a final thought for you to consider as we wrap up this analysis. Building on the implications of Operation Jailbreak, as Leidos pioneers this open architecture, software-defined integration on the battlefield, literally writing the code that forces proprietary hardware to communicate seamlessly, are we witnessing the final days of vendor lock-in for the Pentagon?
It's a huge question. If Leidos can use open APIs to bypass the walled gardens of the massive legacy defense primes, does the future of defense contracting suddenly belong to the agile tech company with the best software architecture rather than the industrial giant with the biggest metal platforms?
It is a paradigm shift that could completely upend the hierarchy of the defense sector, and it is absolutely a trend you need to keep a close eye on in your portfolio. Thank you for joining us on this deep dive.